Good afternoon, everyone. I want to do a sanity check for the online community. Can you guys hear me? Can I get a thumbs up from the Akur8 guys? Okay, thank you. Good afternoon, everyone. Konnichiwa. But again, thank you very much for joining us today, our friends from the various insurance companies, and of course, our esteemed panelists for today, Randy and Raymond. Looking forward to sharing the next 2 hours with you guys. By the way, we have a lot of canapes over there. There are going to be more guests coming in. We also have some refreshments. Feel free to help yourself. Over to our agenda today. We'll make it quick and concise. I think the main meat of this is for us to be able to discuss and also network with each other. We'll have, of course, our Regional Managing Director, Yana-san, who will be presenting an opening remark, followed by, of course, Mori-san and Yan from ABeam Consulting and Akur8 to share about the current industry landscape. And then from there, of course, we will have our esteemed panelists for our upcoming panel session. With that being said, I'll hand it over to Yana-san for our opening remarks.
Use the mic, right? Hello, good afternoon, everyone. Thank you for coming to our office. As you can see, we just renovated our office. It's a brand new, and I think this is the first time that we are hosting this kind of event in our office. We are happy to have this kind of event, and we want to be in the Singapore, connecting a lot of people, and that's why we made this kind of space in our office. So welcome, and please enjoy. I know it's going to be a little bit of boring stuff, but can I just a little bit introduce about ABeam Consulting? Okay. Okay, so we're a global consulting firm, but we're headquartered in Japan, and also our office is mainly in Southeast Asia, China, and Japan. So we're obviously very much focused in Japan and Asia. Our global coverage is, as you can see, centered in Asia, but also we work in Europe and US, which we also work with a partner called Bearing Point. I think Bearing Point member will be joining later. Yeah, so we can also network with them. And our office in Southeast Asia is in Singapore, Thailand, Indonesia, Malaysia, and Vietnam. So anything in those countries, if there is, we are happy to help you, support you in any ways. So nice and quick, end of my presentation. I hope you have a good thing to take back home today, and please enjoy. So I'll hand over to Atsu to share the insight about the insurance.
Okay. So online participants, how many?
You have about
1,000. Yeah. Okay. So yeah, for my part, yeah, I thank you for coming our new office. So my name is Atsuki Mori, head of insurance sector in Southeast Asia. So I would like to share the trend of pricing and underwriting in insurance business. Before the Akur8 presentation, insurance pricing software. So before the Akur8 presentation, I would like to the basic knowledge and experience insurance pricing. So before moving this contents, let me introduce my first career was insurance company, non-life insurance for underwriting department for commercial lines around 8 years. And after insurance, I moved to consulting firm, several consulting firm around 8 years. So based on my background, I'm actually familiar with the pricing underwriting area. So yeah, I'm happy to explain the contents of these topics. Cyrus, can you? Okay. Yes. Okay. Today's contents for me. First is what is pricing underwriting in insurance business, very basic one. And second is the trend of pricing in insurance business, including current positioning of pricing and the challenging points. and future vision. So these contents I want to share that. And the first agenda is what is pricing in insurance business. So today's participants in insurance person mainly, but what is insurance product development and what is pricing for insurance? That is a very basic. And left-hand side, in the insurance product development process, there are some process in this process. One is planning for product development and management policies. And second is analysis of product needs. And the third point is deciding on sales channel and product definition. And scoping for product definition in the right-hand side, there are some tasks for pricing and underwriting. So first is development of sales plan. This is a pointer. There are there. Okay. Okay. So from top to bottom, development of sales plan. And second is definition of products and various conditions to make the terms and conditions. And the third is pricing rate calculation to develop insurance premium rate tables. And fourth point is profitability and risk research. We define underwriting for this session is to conduct research on the profitability and risk insurance products. And finally, to get approval application to regulatory authorities. So this part, I want to focusing on pricing rate calculation from after slide. So next topics is trend of pricing in insurance business, current pain point and current positioning. And this slide is current positioning. What is differentiating factors in insurance business? So basically, based on from the standpoint of customer, maybe when customer purchase the insurance, the price is very important for the customer. But there are some differentiation factors in insurance. One is pricing and the customer experience, distribution network, claim management, and so on. And the point is, among all competitive advantage, pricing is considerable as the most differentiating factor in the marketplace. So in the bottom side, among all insurance industry participants like MGA, direct insurer, and InsurTech, pricing is always among top 3 competitive differentiator. And second slide is explain. So just question of survey, do you monitor the impact of pricing improvements? So pricing improvement is monitored as impact by some KPI indicators. In insurance business, there are some KPI. The major KPI is loss ratio, combined ratio, top line. So, but in this survey result, loss ratio is most important monitored by pricing improvement. So next slide is what is challenge? What is pain points for current pricing process? So, okay. So the question of survey, how much is your business affected by each of the pricing challenge below? So there are some challenges. One is lack of data and lack of resources and lack of collaboration, lack of automation. So for example, lack of data, when insurance company make electric vehicle motor insurance in Singapore. So as you know, Singapore is not a large company. Singapore is a small country. So the number of EV is limited. So insurance company basically wants to optimize their pricing on the statistical viewpoint and profitability and competitive analysis. So but the data amount is limited for creating the new product development. So that is a sample of lack of data. And the second of lack of resources means lack of human resources, know-how, and technical resources. And third point, in terms of lack of collaboration, challenges include the time required for internal explanation and the difficulty of the approval process. And final, fourth challenge point is lack of automation. Lack of automation, we can easily imagine. So traditional insurers has a lack of connection between the different steps of pricing process, revealing a need end-to-end tools. So in the lack of automation, I want to more explanation. Next slide. So this is a non-life pricing process. From left to right, non-life pricing process. One is raw data management and pricing models and review adjustment. This is a horizontal line. And the vertical line is several insurance pricing tool. One is ubiquitous software, including Excel file, and the data management language, and program languages, and insurance pricing software, including Akur8 emblem reader. So there are three messages in the slide. One is in the vertical lines, various variety of tools used to make the process more manual with potential friction and less efficiency, revealing a need for end-to-end tools. So you can see these are very frequented, and and the second point is around in the review of adjustment point, around 30 to 40% of insurance companies are still using Excel file for pricing review and adjustment. And the third point is insurance pricing software using for pricing models starts to be used in pricing model for the by part of insurers around 20 to 50%. So including Akur8 emblem reader. So based on the challenge, the final slide is to explain the future vision for AI and machine learning. So AI and machine learning pricing tool like Akur8, later detailed explanation by Akur8. That is one is a solution for pricing process can be expected to various issues. So AI and machine learning tools can provide the effect of introducing two factors. One is tool integration and task automation. So this means AI and machine learnings can solve end-to-end integration of different steps of the pricing process to create automation. And this benefit is to solve lack of automation and resources, and can calculate the estimation of 2 to 4% of combined ratio improvement in the expected benefit. And the second effect for the implementing AI tools is standardized pricing processes and improve governance. This means is to provide standardized process and governance, and by using transparency increasing. This benefit is to solve lack of collaboration to price model and easy to explain pricing process. So yeah, this is my presentation. And next is Akur8 insurance platform software explanation by Akur8. So maybe that is help. My presentation helps you to understand to clearly, more clearly for accurate presentation next session. Thank you very much.
Thank you very much, Morrison. Well, we're going to be setting up the Accurate, the very handsome fellows of Accurate in a bit. By the way, please go ahead and help yourself stand up because they don't see us, so they don't know if we're sleeping or eating or anything. So, but of course, we will be listening to them. We encourage you to please go ahead and stand up. Otherwise, I'll go to each and individual people and I'll shove food in your mouth. Because they're gonna pack that up by 6 p.m. I think we also have some wine later. So, but anyway, just to preface that, I'll go around later. And yeah, we'll hand it over to the guys at Accurate. Gentlemen.
Yeah, thank you very much. Thank you very much, Mori-san, for the insightful presentation. And welcome everyone to the presentation Accurate will give you now on how the augmented actuary will transform insurance. But before we dive deeper on this, let me give a few slides, not on me, but on the company of Akur8 to show you who we are, why we are having this webinar together with our partners from ABeam. Akur8 is a non-life pricing platform and software provider, active worldwide in all time zones, and helping insurance companies do their pricing more appropriately. And the central mission in that is that we want to empower actuaries, pricing analysts to make better decisions, and that in a faster manner. In order to do so, we help a lot of customers already, be it global groups like AXA, Generali, MSNID, but also more specialized players like, for example, Tokyo Marine Kiln in the commercial sector. And all these use the Akur8 pricing platform to determine how they should price their contracts along the lines Mori-san mentioned in the previous presentation. So in this pricing platform, you can do a lot. You can build predictive models. You can do various reports and other segmentation analysis. But in order to really understand how this could help you practically, we thought we'll bring a pretty straightforward example to the table today, and that is very simple: how the augmented actuary will transform insurance. Then, of course, we need to discuss what how for example, myself as an actuary or your actuaries should be and can be augmented. And for this, I brought a small example that we are gonna look at. Here, this is the world, how it starts to be in some places, but we don't really think it makes sense to make the machine learning to make the insurance pricing world just pure black box machine learning. What do we have in front of us here? When you do pricing, in the end, you want a prediction, you want a price, and typically you use historic data from the past to learn from it. And then in the middle, you have some model, some way to compute this price. And yeah, machine learning, black box models have been picking up a lot of traction here. But as indicated here, they are very, very difficult to understand, not only for the actuary themselves, but also when it comes to compliance issues, when it comes to talking to regulators and maybe even filing your pricing models like in some markets. So then to really pin down the age of the effect of the driver age in here is not really possible. Do we maybe overprice? Do we not fairly price some old customers depending on some other characteristics? That would be really hard to determine here. And therefore, we advocate on the model side, and as we'll see in the next couple of slides, also in the then further analysis reporting side, for clear-cut simplicity and transparency. For example, with the models you would be building in the Akur8 platform, you will very clearly be able to identify the effect each of these variables, each of these characteristics of your customers that you provide a service to will have on their premium in the end. And for this simplicity, we brought an example out of the practice. Let's assume you do some insurance. Let's maybe take motor insurance again as the pretty common example. You have some customers, you have an existing pricing structure. Now you've used some models, you've used some analysis, some time from your actuaries, and built a new pricing approach, a new model. You computed new prices that you want to give to your customers. But of course, they'll be a little different for everyone. My colleague Pedro might get an increase of 20%. For Mori-san, it might be a discount of 10% that he would receive from this new pricing rule. Okay, these are two individuals, but yeah, how does it look for our full portfolio? What insights can we draw from it, and how can we dig deeper? Let's discover this together now. I'll start with rather simple examples, how to approach them, and then not make it more and more complicated, but more and more insightful, and maybe the complexity increases as well, but I'm sure we'll be nicely able to understand how a pricing actuary using, for example, the Akur8 pricing platform can do this analysis in a very clear-cut manner. Okay, so we mentioned the rate change, the price change, that in this example of going from an old pricing book to a new pricing book would have an impact on everyone. My colleague Pedro, he'd be along here, plus 20%. And a lot of other customers would receive way more impactful price adjustments. We can see here on the right-hand side, maybe Pedro could quickly nod to make sure that my mouse is visible. Otherwise, I'll try to find a pointer. Here on the right-hand side, thank you, Pedro. Here on the right-hand side, we have very high premium increases of 60%. Very, very drastic impact, just like a minus 50% would be a very strong impact. And the simple approach could be to just segment this in some categories. In the middle, 15% plus or minus, that's quite stable. We wouldn't expect too much impact here. Customers dislocated in that manner, they likely will stay with us, will not react too strongly. However, for these high price increases, again here on the full right-hand side, if you receive a letter, and from Germany here you still receive letters, I'm not sure how it is in Singapore when you get a price adjustment. When you receive a letter and it tells you, yeah, pay 30% more now, people are not very happy and are very likely to lapse the insurance contract with you, go to one of your competitors, likely something you don't want to, again, and leaving aside the regulatory limits you have in some markets on how to adjust. But also on the other hand side, here on the customers that, if we just use these prices, would receive very, very low prices. Yeah, likely they are going to stay with you, but also it could be a little bit of a waste, of a loss of opportunity to not ensure stability and only give them the 20% discount, again, based on the regulatory limits. So along these lines, of course, simple strategies could arise. What you do with this insight of, okay, we'll drastically change some prices for some customers. First, simple strategy could be to impose no constraints, to do it as the model, as the predictive analysis had indicated. Some other scenario could be to squeeze this in a little, to do a softer update, to shrink it a little. you can see how the distribution of adjustments here is way more centered around 0. So you will push every price of every customer a little bit into the right direction, purely looking at a loss ratio indication. Some will still get high increases, but not everyone will be fairly priced in it. So that could be one scenario. Or maybe even a little more simple, you could just cap the updates, choose minimum and maximum price adjustments, and cut off all the other sides. That would be an approach often done when regulatory constraints are of a concern. Or not a concern, but need to be taken into account. So these three strategies, they are not bad, but let's look at them in a little bit more detail when you have the proper analysis tools. How you could get a little bit more insights of the impact of these strategies when you don't just look at this simple distribution here. And then a very simple way could be to take this fraction that we had before, the price change, and just put the denominator and the nominator on the axes here. So we have the current premium our customers are paying on the x-axis, and we could put the proposed premium here on the y-axis. And then here on the diagonal, these customers, they would not receive any price change. If they paid 500 euros, dollars, whatever before, they would pay the same amount after the price adjustment. Customers here in the lower half, they would receive a price increase. Instead of the previously 500, now they only pay 300. And to the same extent, these up here would get in price increase. And now this by itself does not necessarily show us that much new things. It's directly it directly gives us the chart we had looked at previously, where we put the simple rate change, the fraction here at the denominator. And therefore, every customer above this red line up here receiving premium adjustments of more than 50% would be present down here. But there are a few more things you could already derive from this chart here. For example, on the general distribution on the exposure segments, because maybe down here doing an adjustment for people paying 200 only is of a different severity to the different KPIs you look at as a company. And Maurice-san mentioned some of the different KPIs companies look for from their survey. And then if you are driven by the top line, you might want to put a lot more attention on how you treat these high-paying customers. That could be a first way to address this here. But of course, also the scenarios can be directly carried over into this still somewhat simple view of the no constraints, of the soft updates, of squeezing things in a little, and then on the right to have a clear cut, and therefore the color here is the amount of exposure. You can see that now you have way more mass points on these diagonals. So very simple starting point, but nicely we have been able to focus more on the points, on the impacts that we really care for. And of course, you can then imagine how you could act differently here. This needs not be a diagonal cut point. You could also use some more complex simplex rule up there in order to adjust these premiums. So, and yeah, in this simple, straightforward analysis setting, I want to now show you two more ways how you can dig deeper with the proper tooling, with the proper knowledge can use it to understand even more of what's going on here. Because maybe we have been able to identify how different premiums, different high or low paying customers are affected. But we know much more about our customers, and there might be much more features we want to check for, we want to care and understand for. So for example, here, we could just look at the rate change per variable feature. Here on the x-axis, we now have the value the vehicle the customer bought had at point of sale. 20,000 here, in this case it's euros, 20,000 euros, 100,000 euros on the right. And we could, for example, see that the premium adjustment we are doing is rather strongly correlated with this value of the vehicle at purchase. The cheap vehicles are increased 30%. The expensive vehicles get a discount of 10%. One question now, of course, is, do we want to do this? Is this in line with our company values? Would it have some implications? Aside maybe from further then on top of that market situation, price elasticity considerations, maybe again, these customers would be okay paying a little more if they have a good insurance product. Also, this analysis can be, of course, brought in. But here in this particular setting, I want to focus your attention a little bit more on these numbers here. If I go back, you can see the scroll bar in this list. Yeah, here in this data set, you have a very, very long list. You have lots and lots and lots and lots of variables of information you know about your customers. If you were to check each of these 100, 200, whatever, how many informations manually, go through it, flick through it, ponder, okay, do I see something here? Is it interesting? Is it not? That's very time consuming and, to be honest, quite boring for the pricing analyst doing that work as well. So I promised you two nice examples how Akur8 gives you a nice transparent analysis along the way of understanding the premium impact. Here, with this number, you have it. Let me maybe not explain how it's computed, as that's a little more complicated. But the point is that we are able to rank the significance of each of these effectiveness variables here. So, for example, by putting vehicle value on top, we put it on top because we saw in some analysis in the background that here the effect, the difference of the rate change is the most significant. For the usage type, whether I use it for private, for commercial, for mixed use, the value is also high, but it's way less impactful. And maybe there are 100 other variables you then don't even need to look at. So here, this score we compute for you saves you time, focuses your analysis at the points where it really matters, where there is something to be discussed. Like, for example, here, what do we do with this clear difference in price adjustments? A second example, you somewhat remember this chart. We've seen a similar version before already, but we've added basically a fourth dimension now to it. Before, we had the axis being the same, and we had the color intensiveness as indication for the exposure. Now, as Maurice mentioned, that the loss ratio is basically the most important to the participants of the survey. We by default produce this chart and all the analysis that you would be doing on the platform. And this fourth axis is now the loss ratio. So we've colored this chart we've discussed before by the proposed loss ratio, by the loss ratio that these proposed premiums would give us. Again, if you are here on the axis, you wouldn't receive any premium change. but still your loss ratio could be quite different. And this highlights lots more of interesting parts of your portfolio. For example, down here, these red clusters, these are customers that received a premium increase. Basically, for this year, their premium doubled from about 200 to close to 400. But still, they would have a loss ratio larger than 1 in this segment. Is that good? Do we want that? In Akur8, you would now be able to do an analysis like this one here, but specific to this small segment here to understand, okay, who are these customers? Is it maybe some randomness, or is there some signal? Can I identify some customers that I maybe then want to treat differently? And basically have then a fourth, a fifth, a sixth scenario or strategy on how to adjust these prices here. Maybe you do some capping, but you also treat some of these clusters here more appropriately. Just like maybe this blue one up here would be a cluster that you increased from 400 to 600 euros, and their loss ratio is now super low. Maybe it's too low. Maybe you don't want to increase prices for these that much. All considerations you could have coming from this starting point, where quite complex relationships between a lot of variables can be made transparent by, for example, combining these charts and this focused analysis to, as mentioned, augment the actuary and let them make good and transparent decision in a faster manner. Thank you. That was my my presentation for today. Pedro later on will expand a little bit further in the panel, but I hope it was interesting to show you some ways on how to understand price adjustments a little bit more deeply. Thank you.
Did you guys get a clap? Did you get a clap, Yan, Pedro?
We can see the claps.
Thank you very much.
Okay, one more time. Thank you very much, Yan and Pedro.
Yes, there it is. Thank you.
Any hard-hitting questions? Was there profit margin or something? No? Kidding. No, but before we proceed with the panel session, let's take like a 5-minute break and just get some food because, yeah, it's just there. It's delicious, and get some drinks. Stand up, encourage everyone to stand up, mingle with everyone, competitors, friends. Maybe your next job is around the corner. So yeah, go ahead. I like that Sugiyama-san was the one that laughed the hardest at that joke, but yep. Please go ahead. Pedro, Yan, we sent you food as well. I'm not sure if it's gonna be there in time. We just sent it 5 minutes ago. Can you guys hear me? No.
Yes.
Yes,
So
I can hear you.
what did you send 5 minutes ago?
We sent you food as well, all the way to France.
Okay, we wait for it then. Thank you.
Okay. Yeah, let's just let them mingle for a bit.
We'll talk in 5 minutes.
Yep.
I guess I'll grab a coffee in that case.
Do you guys have a hard stop? No. Okay. Just give them a few more minutes to settle down if that's all right. When are you guys going to Asia next time? No?
Well, actually, I'll be in Asia in just a bit more than 2 weeks. The 23rd of October.
Whereabouts? Japan or?
We're going to Bangkok. Actually, a few colleagues going to Japan before that, I think next week. But I'll be flying to
I was just
Bangkok.
there 3 weeks ago. I was there 3 weeks ago, Bangkok, for
Amazing.
a conference. Give me 1 sec. Let me just. I realized you're not seeing me.
I can hear you well though. Okay, now I feel very self-conscious of having my face in this too big screen.
Maybe we're gonna do a shout out to the online crowd. Can they comment or chat? The online crowd? No, I don't think they can, right?
Not sure.
It'll be interesting if some like very important person's watching, right? And we didn't even know that. Oh, there we go. Q&A.
Only Q&A, yeah.
Oh, they can only type there. Okay. Thanks, Lucille. You guys are missing all the fun here. Ah!
No, I know. And
yeah, I just realized this
really
is not a very
see-
good angle.
Likely also the nice temperatures. It's super cold here for me in Germany.
Okay, here you go. This is a better angle? Yeah.
Yeah, looking
Yep.
very nice. And I guess Randy and Raymond are probably there mingling, and it'll be there the chairs, right?
That's 20 people. Or sorry, VIP. I'm just gonna practice my stand-up routine here. So, okay. Shall we go ahead? Shall we start? Yeah. Okay. Hello, everyone. Yeah, you can continue to chat later, but I bet you'd want to hear this. So look at that. How do you like my prop? It's like a clipboard. I have real questions. There you go. See, with a paper. Okay. Thank you very much, everyone. Hope you enjoyed the canapes and the beautiful wine that is carefully curated by Mori-san. Fun fact, Mori-san is not only the head of insurance sector for Southeast Asia, he's also an officially certified sommelier. There you go. There you go. Yeah, see?
You're really
That's how
missing
classy
all the fun.
Yeah, that's how classy ABeam is. So because of today's Akur8, yep. There you go. Look at that. Shout out to Akur8. Of course, our beautiful friends at InsurTech Connect are here. Go ahead. Okay. Thank you, everyone. Hope you've had a very informative session and enjoying the food and the company and meeting new people. I'm very intimidated by actuaries. Did you know that? Like every time I see an actuary, like I feel like they're gonna tell me, it's like, you know nothing about insurance. You can't price, you don't know how to do stuff. And with that being said, because I'm very insecure about that, I keep very close friends with me who are experts in the field. Look at that. That's a very nice segue. Joining us is our esteemed panelists, starting off with Mr. Raymond Chung. One of his many, many hats, he's the Chief Growth Officer for Delta Underwriting, a well-renowned actuary in Singapore. And of course, joining him and us as well is no less than Mr. Randy Liu, Head of SCOR Ventures. If you don't mind, gentlemen, hope you can just share the mic. Give me 1 second. And of course, all the way from Phones. Is that how we say it? No. It's Pedro and Jan. They're going to be sharing the thing. Okay. So our topic for today is, again, we've been talking about technology, data. You've heard all about it. And I think we were just chatting earlier with Moritz. He was in Europe for a conference last month or a week ago. And then I think the narrative has shifted, especially this time. We're very particular about combined ratios and like finding like immediate results out of these technologies that we see in the market. While it's fun to talk about risk regarding crypto or what lies ahead in the future, when we go back to our meeting rooms tomorrow or next day, we'll ask about what revenue are generating, what costs are we saving on. So with that being said, we'd like to identify how this new data and technology will be able to address traditional, upcoming, and future risk. With that one, Mr. Chong, in your years of experience, as I've celebrated you over and over again, what have been the material changes you have seen adopted in terms of pricing in the market? From a data and technology standpoint, which products have gained most out of? It doesn't have to be fancy. It could be something, a macro sheet that you've seen that has been used by a company or something like that. But yeah, technology and products that have gained most out of it.
Thank you so much for that question. I think that is a very relevant question for today. First of all, let me just give the very quick introduction of what pricing from insurance standpoint. Generally, there are two types of pricing technology. Techniques. First is called experience rating, and that is mainly for those lines of business that you have significant data. So, for example, motor, personal lines. When insurance company have data, they will use experience rating to do the pricing. And those lines of business where you don't have significant data, like commercial lines of business, usually we use another technique called exposure rating. So we look into the exposure rather than the experience, which is the database that you have. When I look into this spectrum of ranging from experience rating to exposure rating, I see a trend of merging of these two techniques together. The reason is because when we are talking about traditional actuarial pricing that Akur8 also mentioned about, like generalized linear models, where traditionally we use it to price motor insurance. But one significant trend that has moved beyond the traditional pricing is because right now we are not just dependent on past data. One of the key determinant factor of GLM is that you need to, based on past data, and for them to assume that the past data are going to reflect the future. But I was in Grab for 2 years, and they collected mileage data, which is actually not past data. They actually are current data. And because of that, they put in some of this information into the experience rating technology methods and combined a bit of experience rating and exposure rating together to launch into some of these pricing of the future. So in a way, I see, for example, motor is one line of business that I see the most changes because of the likes of these ride-hailing companies coming with motor telematics type of techniques that come into the market over the last few years. And many of these companies, including insurance companies, are starting to use the telematics as a way to supplement the traditional generalized linear models. And of course, it does move into some other lines of business as well beyond motor. So I think that is probably one of the trends that I see that the pricing are moving towards.
Thanks, Raymond. I think telematics is a very good example of an available data and technology that has been there, which has been adopted by the insurance industry to a certain extent, but not to a level that we'd expect. Like, for example, we keep talking about pay how you drive and you have granularized pricing. Then again, your competitor would just give you 20% discount and all of that effort goes away. But with this, of course, you mentioned about Grab and new digital behaviors that's present in motor vehicles, even in health lifestyle apps. I'm pretty sure half of the room has an Apple Watch or a Fitbit somewhere. And again, it's very charming to think about, what can we do with that as an insurance company? Yes. With that, I'll hand it over to Randy. In terms of new product development, this has been a key topic with the emergence of new digital behaviors, as you mentioned, like your Fitbits, Apple Watch, health data, even maybe in IoT with commercial lines. What are some of the new products in the market that you view could be game changers? And what do you think will be the underlying challenges in developing this?
Yeah, so I look after SCOR Ventures in the Asia Pacific region. So in my role, I'm pretty lucky to get to see a lot of new ideas pitching to us and applying new tech to insurance. I think I don't know about game changing, but a couple of pretty interesting products I've come across recently. One is insurance for new tech, such as AI or green energy tech. And what I found most interesting is the type of products designed to help endorsing or get investors more interested or comfortable with green energy tech, for example. Whether it's offshore wind farms or solar energy, or AI models. We see more and more, I think, what is called performance guarantee products being developed in the market to help facilitating the developments and the investments in new technology in the AI space and also green energy. Second example I can talk about is related to climate / biodiversity. We see some countries or regions are making use of greenlands, grasslands to store carbon in order, for the countries to meet their carbon emission targets in the long run. And so we're seeing now in insurance, reinsurance space, people sort of coming up with very good ideas to help ensuring these type of projects from both a project management risk standpoint and also nat cats, wildfires that can happen to the lands that governments are trying to restore. So a couple of those examples, I found it pretty interesting.
No, very interesting. I was just having a chat with a VC friend 2 days ago. Her new venture is they're tearing down old planes and then recycling them for getting carbon credits. And apparently carbon credits has been a multi-billion-dollar industry, not only the past 2 years, but for the past 7 to 10 years already. And companies like Shell have been taking a lot of money, Tesla even with this one. And maybe Randy, I love the venture game, identifying upcoming startups. Maybe you can give us a freebie. Which startup has caught your interest recently that the audience might want to take a second look at?
You want me to cover that now, or
No,
during the drinks maybe?
Just one, just maybe one for the online audience as well.
We have really a pretty long list of deals that's on the desk right now.
Okay.
We've been looking at players in the trade credit space, helping merchant acquirers to absorb the chargeback risk that they're exposed to. As one example, we're working with startups trying to break into the SME insurance space around India, Southeast Asia, and also Australia. And we are also, what is the one that I have on the desk? We're looking at green energy. And also circular economies. We have a couple of those companies here in Singapore. So providing extended warranty products from an insurance standpoint to help some of these used electronic gadgets being circulated or recycled is one way that we think of to help the startups to grow.
Nice. Yeah, I think we'll need to get you a few more drinks, Randy, so that you can start naming names. But by the way, you mentioned SME. ABeam has a very good service on providing SME ecosystem for insurance companies. Just saying. But speaking of promising startups, one of the most promising startups on my list for the past 5 years is a little company called Akur8, which you might be familiar with, Pedro and Jan. With that being said, so we've heard about how it has changed from a traditional product perspective and an upcoming one from Randy. And of course, as one of the leading service providers and working closely with insurance companies. what were the factors that led to fast and successful implementations of your solution? And I think everyone from the insurance industry, they throw you, people like me and Randy will throw you a solution. All of a sudden, IT, crickets, nobody move, and the whole scenario. What are the factors that led to fast and successful implementations of your solution? And what are the usual challenges that organizations face in working with you? What will be a perfect scenario for an insurance company in terms of implementing your solution, as they've heard earlier? Go ahead.
Thank you, Cyrus. Thanks for the question, or rather the 3 questions. So maybe just before unpacking that, I wanted to first thank you for the invitation and really congratulate ABeam on the new office and this really excellent organization of the event. You could not have chosen a best host. I suspect that you'll be telling all the people rather at the networking about your TV show host experience now, because it seems the Cyrus is just a natural in presenting this sort of events. Again, thank you for the invitation and congrats on the organization. To unpack the questions, I would say, well, first I could spend probably 15-20 minutes on that. I don't want to spend too much time, but when we think about the ideal scenario, I would think that most of the time people will be paralyzed thinking about what the ideal perfect situation is. As long as you have a business challenge of maybe you want to improve your loss ratio, maybe you're thinking about growing your portfolio, you're thinking about differentiating your pricing versus the competition, and you have this top-down mandate from management, that'll be enough for you to start looking and really taking pricing quite seriously. I'll give an example of in one of my recent travels, I met with one of our customers that have been customers of Akur8 for about 1.5 years now. And they're from an emerging market. I would say not a super new player, but they have been in the market for almost 10 years now. But they don't have the old school processes that some of the insurance companies do. And when they did a POC, so the senior actuary was telling me, the value that we saw in Akur8 is that we wanted to get our motor personal lines and be able to include more rating factors, have more advanced segmentation, improve our models. And now that after over 1 year using Akur8, we have done that, but we have gotten much more of an expected value and done other things that we didn't expect to. And now when we're looking at lines like farm insurance, SME insurance, that we were before prioritizing and choosing every 6 months or every year which lines we should focus on and to rethink the pricing. Now we're able to do this twice a year for all the lines that we have. Now, thanks to the machine learning approach and the user experience of Akur8. And I think this really relates to what Raymond was saying about how experience-based and exposure-based rating are sort of merging, and we're really moving into a place where commercial lines, they're starting to look at their data, the past data and present data to see how this complements this analysis of exposure and this more knowledge-based approach. So definitely a trend that we'll be seeing in the market as well.
Yep. Thanks, Pedro. Let me try that again. Thanks, Pedro. Thanks, Pedro. Yep. So for the 3rd time. No. Okay. Think about the best project that you've worked on, Pedro and Jan, with Akur8 and the insurance company. Obviously, there's a top-down approach. Would that be a in-country CEO, regional CEO, group CEO? And then the working team, what does that look like? Does that comprise of a dedicated person working on the project? Does that comprise of like an upcoming, very hungry actuary in the team who also is familiar with digital tools? What does that look like?
Yeah. So usually when you think about an executive sponsor, that would be a head of products, let's say head of motor lines or head of SME. It could be the CEO, depending on the company as well. But in terms of who the users of Akur8 are, the team they're directly working with, it's usually an actuarial department. Could be chief actuary. It could be head of pricing. The job titles will vary from one company to the other. But the users of Akur8 will have some sort of actuarial or statistical background. They don't have to be advanced experts in pricing. No, it's also one of our it's part of our value proposition, and the value that you can bring is to train you and bring you up to speed into the best practices and advanced techniques in the market. But we usually work with people who have a good level of education and really know what they're doing. Most importantly, they know about the business. And we're here bringing a method. We're here bringing technology, a way to enable you to get most value out of your data and out of your knowledge.
That sounds good. It seems like Akur8's bridging the gap in terms of like a technology gap perspective, a domain perspective, and also business perspective. But even with that, I'll shift gears a little bit with Raymond. So obviously pricing has been there, new methodologies, but we've been looking at the same products forever in the insurance industry. And as I mentioned earlier, and I think Randy touched on it a little bit earlier in terms of climate and ESG coming around. Well, it's here, right? On top of that, which risk or product do you see in the near future would need much attention? So we've heard about carbon credits already, but other than that, anything that you can think of, maybe somewhere along like electronic vehicles, maybe. I know there's some considerations in how you price that because of the claims are yet to be seen in terms of like volume and severity. Crypto is another very popular subject 24 months ago, not so much, but those crypto bros will be coming around soon. So yeah, any new risk that we should be looking at? Maybe?
Right. Thanks for the question. Let me bring take one step back and just to talk a little bit more on the digitalization of insurance, and then from there I'll answer the question because that is very much related to it. InsurTech or digitalization insurance have moved into different phases, right? When you first started, insurance companies see InsurTech as competitors. They don't want to work with them. So they work very separate. They try to come up solutions and just cater to their customer needs, and then eventually trying to disrupt the insurance sector. But that has moved to phase 2, where insurance companies see the value of InsurTech and then move together and trying to work out something. And in fact, some of the function, including pricing, product, claims, are now being done through the InsurTech because they have the technology to reach out to all these things. So they move to phase 2. But the future of insurance, in my view, is move one step further to go into what I call ecosystem insurance. In ecosystem insurance, the InsurTech or digitalization is embedded into insurance function. Essentially, when you sell a product or services, insurance is actually embedded into the whole ecosystem, whether it's in the vertical supply chain or the horizontal e-marketplace. And with this ecosystem insurance type of concept, you realize that products pricing will have to change form. Just now I mentioned about the traditional way of doing pricing is GRM, for example. GRM, we look at past data and try to assume that this past data will reflect the future, and that's how we do the pricing. But in an ecosystem insurance, we are basically encouraging or influencing the insured to improve their risk as go along, because we collect the data, telematics, motor. In healthcare, we collect their Fitbits data, and we are informing them that you need to eat healthily and do healthily. For driving, we encouraging to improve their driving skills. So in other words, the risks are changing. You can no longer use the past data because the past data does not reflect the future anymore. That's one problem. Second issue is that because we are changing risks, we are collecting a lot more unstructured data. And this unstructured data, in a way, very hard to fit into the traditional generalized linear models. We need machine learning and AI. Basically, Akur8 presented something just now. We have to use new techniques to do pricing. And with this ecosystem insurance concept, we realize that many of the things I talk about, like crypto, they are very much in the ecosystem. And we need to look at the whole ecosystem to fix that kind of pricing. And in fact, I will say that for the traditional way of doing pricing, where we are using a very differentiated pricing technique, using very, very sophisticated technique to do pricing, will probably only suitable for very large risks, very like some of the building risks and all that, commercial lines. We probably still very much differentiated. But in the ecosystem type of insurance, we are talking about mass. In a mass volume type of risk, we are simplified the rating such a way that uniform price, but we adjust the exposure according to the price. So in other words, to me, the future of insurance, there'll be two types of pricing. One type is you still adjusting the premium according to the differentiated risk exposure for the very large risks. But for the smaller risks, we are talking about volume, mass risk, we are fixing the premium, but we are adjusting the risk exposure for that. I'll give one example. In Indonesia, I'm actually running a startup. And what we are trying to do is introduce microinsurance to this community-based farmers, and villages and all that. We fix the price as about $10 per year. And they just pay, whether you are old, young, whether you have pre-existing condition, I don't care. You just pay the same amount. I'll cover you based on the fixed sum insured. So that's why we adjust the risk exposure, but we fix the premium for that. And that catered to the mass. And that only useful when you have an ecosystem because you are catering to the big volume of risks. And because of that, Wendy, I will have to talk to you because I'm also looking for funding. Anyway, so but that is what I see that the way of looking at pricing.
That's just I don't even know the words. That's a very refreshing take. It's not about the product, but it's an approach, how we look at risk, and that's an ecosystem play. And you did mention about embedded insurance. I heard the gentleman coined a very smart term called trapped insurance. Embedded insurance is, it's embedded everybody, but trapped insurance because you're already part of the ecosystem. There's no way for you to escape. And guess which gentleman came up with that trapped insurance is the gentleman who I'll be asking the next question to, Randy. Speaking of which, so Raymond, about like new ways of like looking is from an ecosystem perspective, that's how you price a product. What do you think are current technologies or data points that are needed to be able to address this type of ecosystem approach, or perhaps any other upcoming risks that you're seeing, like from a data or technology standpoint? So for example, right, commercial insurance, we're looking at IoT devices for commercial factories, which means like previous machines that were not were excluded before could be underwritten now by certain companies because you have additional data that you can look at. And from that ecosystem standpoint, I'd imagine like mass data from different sources, which again, good luck with that, by the way. But with that being said, Randy, any data or technology play that you're looking at that could help accelerate the new way that we're looking at pricing?
Yeah, well, I think I very much agree with what Raymond said about how we price the risk that's moving, that's changing all the time now. The risk universe is moving. And there's a lot of different moving parts. So a lot of the new products and new risk emerging ones, we don't have any claims data to rely on to do pricing anymore. So the question is, what do we do now? So I see, so I used to work as a CAD modeler. I did that for 20 years actually, before moving into the venture space. So the CAD model developers had a pretty, I think, pretty smart idea, right, of building the so-called physical models by fundamentally trying to understand the risk of that CAD. How a tropical cyclone forms above the ocean, how they travel, at what angle, and how they make landfalls. And once they do that, the wind blowing against your buildings, causing damage. And then that translates into financial and insurance losses. So this whole process gets simulated in the CAD models we use today. And we've been doing that for about the last 25, 30 years now. And that's worked pretty well. So I'm aware people who's working in the cyberspace trying to adopt similar approach by building basically simulation to mimic what can happen in the real world, but in their software models. And this is basically an exposure pricing or modeling approach. When we don't have the loss experience to do the pricing. Other than that, I don't know. So data science, it's a interesting space, but I don't know enough about, like in terms of all these new, even like for cat risk, we have all these new geospatial data becoming available, satellites, IoTs that measures the flood depths, wind speed at the very hyper localized level. So I think people are still trying to probably they need to first ingest the data, right? We have a lot of data, but we don't have a way, to ingest and really incorporate them into the existing models we have today. So that's one issue. And then the second one is, how do you come up with smarter models that could potentially simulate the risk for us? These are things that I see people are working on right now, but it's pretty early. We see some signs in the cyberspace where stochastic models are becoming more available. But yeah, so I think the lack of experience data is also giving us a lot of opportunity to look elsewhere and apply kind of the first principles that we know about risk, and then apply the exposure pricing approach to price and underwrite the risk that's moving a lot.
Again, thanks, Raymond. Again, a very, how should I put this? A pleasantly surprising answer. I was expecting you to say something, oh, there's this technology that can do that. But what you're saying is like, there's already data out there, but it's just, we need to be better on how we'll use this data. And Raymond also mentioned the ecosystem already exists. And again, the data is there. And then we'll pass the hard question to our friends at Akur8. Hearing this, Akur8, what are you guys doing about that? I'm kidding. But so again, so we know this, that there are no risk to be approached. Ecosystem plays, very captured audience, readily available data. Again, it's easier said than done. What are the steps at Akur8? And this, your turn to promote your company. But what are the steps that you guys are doing in terms of new product development? Hearing this, like, are you guys like just using existing data from your clients and any readily available and familiar data? Are you also ingesting new data, and are you experimenting with that? Doing some POCs with some partners? How does that look like with Akur8 right now and your partners?
Yeah, thanks, Cyrus. So what I hear from what Raymond and Randy are saying is really almost two diametrically opposed challenges, right? On one hand, you have the developing products where there's just not experienced data available, right? Like cyber insurance or new products being launched in the market. And on the other hand, you have how to deal with more data being ingested from IoT devices, regional data, or commercial data in businesses and in different companies, and then how to deal with all this data coming in. So I'll tell you on the first part. Unfortunately, when you think about data science and machine learning, there's no miracle. So you cannot really, if you have no data, what you can do with that is very limited. And that's where the creativity of the insurance companies is going to be a deciding factor, because, for example, you may be able to access market pricing data to do some sort of reverse engineering of how the pricing is done to have an initial benchmark. Or you may have a physical model, sort of the analogy that Randy was doing with the cat modeling, to do that as a starting point. And as you collect data, you'll be able to more quickly refresh your models, and that with very few resources very quickly, thanks to machine learning. So that's where Akur8 is going to help. So that's on the product development. I would say on the other, the second challenge, that's where we've been adding the most value, I think, because when you think about telematics, IoT, these large amounts of data, sometimes quite unstructured, it is, let's say, it is useless for the data teams and the actuaries to spend time cleaning their data and just having everything ready to be exploited if you don't have a tool, a solution, or technology that allows you to quickly iterate easily find what is really signal, what is not, what is trash there in the data. And if you spend a year doing that, it means that maybe this data is outdated and is not relevant anymore. So what Akur8 can bring is, let's say that you have a data set with hundreds of columns of different types of data. You can have an algorithm that's going to tell you very quickly what is the information that can be relevant for you to, depending on what you're trying to do. If you're trying to determine the risk, or you're trying to determine how likely your customers are to renew a certain insurance policy. Akur8 is going to tell you very quickly whether this information is relevant. Is it worth buying this data, or is it worth working on obtaining this type of data, just so you can make the decisions quickly and not spend too much time on things that may not necessarily bring value to the business in the future. So I'd say that's where the areas of working on today.
Mike. Okay, thanks, Pedro, for that. And thanks everyone for the wonderful discussion. Any last comments before we wrap up? Raymond, Randy, and Pedro? Yeah, we'll keep in touch. Okay, thank you again, Raymond, Randy, and Pedro, for your time. Hopefully, by the way, for the audience, any questions? Please, a planted one. No? There you go. Yes, sir. Yeah. There's two of us now, so.
Which is how do you do all that? Because you're doing a pricing for future. Yes. Data is a part. You mentioned that. Data is a part. You're pricing for the future. Let's take an example of health spaces. Critical illness product. Let's make it very simple. Critical illness product. Cancer pricing. You take past data for 10 years, whatever you do. But cancer is new. The treatment has moved. Things have how do you factor that in based on the you have past data, but just past? How do you take it off?
I'm not going to answer it. For the online audience and for Pedro, the question was, how do you factor in future data as well? So an example cited was, if you look at like a medical product, like cancer product, of course you have historical data and exposure data, but cancer is also changing. How do you factor that in terms of your approach to pricing? Raymond?
Okay, so maybe I answer Roger's question. Because I have done the critical illness pricing, and especially for a micro insurance type of context. So for me, the kind of for health is actually easy because you do have a lot of data, even though it's changing, but you do have quite a substantial data for that. For critical illness, cancer-related type of diseases, the frequency is 2.06% frequency. So it's very, very much around that. And what you need to do is fix the severity. So you fix the sum insured. Once you fix sum insured and frequency is around 2.06%, you can come with a burning cost. And from the burning cost, you just do a markup. It's very easy to come up with a very simple way of pricing. And from there, you can basically price is a function of risk exposure and volume. So you have to estimate the volume, and from there you can just price. I have done actually one of my previous consultancy work. I've done for an insurance company that, I mean, they are actually not exactly, they are actually more a digital insurer that price crypto insurance. And crypto is even more complex. The reason is because actually there are data there are crypto events happening all around the world. It's just that they are not centralized. So there are many data out there, and some of them are not clean. So you have to clean the data. But other than that, they are actually data, but the data are not really good to come up with certain pricing. So what I advise them, again, pricing is a function of how do you craft out the whole ecosystem, right? I mean, you can, based on the loss experiences, all the crypto losses by all the different exchanges, come out all the different frequency, severity, you combine them together, come with the base burning cost rate. But that is catered to what kinds of this is catered to a certain losses that you assume in the market. But from there, from the base price, you kept the sum insured, and then you put in some underwriting underwriting criteria. So, for example, you say that you only cover cold wallet, you don't cover hot wallet. As a start, you also don't work with very new exchanges. So, in a sense, pricing is also a function of how do you put in the parameters, underwriting parameters, the limits, the deductible. All this come in the whole pricing. Then eventually, at the end of the day, it's still uncertain because you don't know the price. So you put a margin. So that the margin will cater to any uncertainty. And then once you collect your own data, the exposure will change and you have more experience. Then you factor in your experience. It become like creditability theory. I'm sure Akur8 understand that. So you from there, you become a mixture of experience pricing and exposure pricing. And then from there, you move. So to me, pricing is very dynamic. From that point of view, it really depends on how do you factor in the various components of price. And when you come out the base price and price is too high, it's okay. You kept the exposure. You put in underwriting condition, and that will craft out a price that is suitable for your target audience. So the most important is to understand what you want to cover, and then from there, how do you craft all the condition with the price in it, and then change over time as new data comes in, new information comes into the picture. Yeah, I hope that give you some idea.
Still not convinced. No, you can have more drinks. He used to work at AIG. I'm sure you know that, right?
Okay.
You used to work at AIG.
Yeah.
Anyway, Pedro or Randy, anything to add to that?
Maybe if I could quickly add
There you go, yeah.
the remote side. Following up on the last answer, I think it's quite valuable to have a clear differentiation between the inputs that come from the past and those that you would therefore even more so assume going forward. So to basically have then various statuses or scenarios. How would it if we extrapolate today, and how will it be tomorrow given these assumptions? Because if you don't separate this clearly, which you of course can do in a good pricing platform, it's hard to challenge one of your assumptions later on. Then you won't know why your pricing was off or something, but then you can pin it down to the exact assumption that you made and see the robustness in it.
Yeah, I very much agree with that in terms of using scenarios. And it's something very different from the critical illness example, but I've recently been talking to a company in the UK that models the transition climate change risk, not the physical risk to do with climate, but the transition. And they're building scenarios to really forecast out to 2100 using various economic scenarios. So it's just maybe something that we can learn from that.
Very interesting. I think I want to be an actuary now. No. Anyway, thank you very much again, Randy, Raymond, Pedro, and Jan, and of course our online guest. Apologies, you went over time. I think that's a sign of a very good panel discussion. I think it was one of the most informative panel discussions I've had in a very long time, except the recent one where the regulator was arguing with one of the CEOs. But yeah, nonetheless, it's right up there. How about a round of applause for all our panelists? And for the online audience, Pedro, Yan, thank you so much. Kun Paul, thank you very much. Sawadee Kap, and online guest, if you're still there or you just left your computer, you can turn it off now. We'll go ahead with our networking. Thank you very much, everyone. Have a good afternoon and good
Enjoy the
evening.
drinks.
And we'll proceed with the networking, please. Go ahead, party. Thank you.
Thank you very much. Enjoy.